inflation targeting by the central bank, but now we will speak about financial development. Argentina, as you all know, is a country that has a financial system that accounts for 15% of the GDP and a bond and share market, which is fairly small, a capital market which is fairly small. So having a dynamic financial system is very important for its development, as well as for the objectives set by the central bank. And for that reason, we have this panel, and I believe we have the best two people to speak about the relationship between economic development and financial development, and the importance of the financial development. Robert Townsend and Raghuram Rajan, both of them dedicated a big part of their academic studies to research the relationship between economic development and financial development. Both have written on the importance of using the economic science in order to understand these processes. Raghuram has written about the risks of letting policy influence credit allocation, and Robert Townsend promotes the use of data and microdata and economic science to evaluate financial systems. Rob studied extensively how organizations are set up and contractual environments of financial systems in the medieval times, in the India people, and developed databases about financial transactions, which is very important in Thailand, to study the economic and financial development of Thailand. Raghuram has also completed his academic life being the chief economist of the IMF, and up until a very short time ago, he was the governor of the Reserve Bank of India. And both of them will bring all their experience to this podium. So I will not interfere anymore in their presentation. I would like to thank both of you very much for being here.
Well, good afternoon, and thank you for inviting me here. And this is a tough session, the session after a very good lunch. So my job is to keep you awake. So let me see how successful we are. I'm going to skip the presentation. I'm going to follow Arminio and actually talk rather than show you. I didn't have graphs, so it's not much of a loss. But let me talk broadly about financial development. It follows very directly from what we talked about this morning, that one of the most important benefits of macro stabilization, of which inflation, bringing down inflation is a big part, is really the ability to then develop the financial sector. And so what I want to talk about today is first, what are the benefits of financial development, what are the key aspects of it. But also I want to talk a little bit about the political economy of financial development, some of which I think drawing from experiences elsewhere, but also I think would be something that you would be familiar with here, and then conclude with these various points. So let me start first with why does financial development make sense? And obviously everybody understands that to get the flow of credit going, to get productive investment to move to a higher plane, to get consumption going not just from savings but from borrowing, you need financial development. You need and there's a fair amount of literature which suggests that financial development does add to growth. Now, whether it's a direct cause or it is an enabling factor, that's something we could debate for a long time. I think it's a little bit of both. But certainly there's a strong correlation between financial development and growth. What is an important aspect of financial development that we don't pay as much attention to is the necessity of financial development in creating more stability. And let me give an example of this. Certainly from my country in India, what we have is a very bank-oriented system, which means basically almost all the risks fall on the banks. Even non-bank companies, when they raise money from the banks. So when we see the non-bank companies taking greater risks, you have to therefore conclude that the risks float back onto the banking system. And banks are well suited to certain kinds of financial transactions, to certain kinds of investments that they can make, but often you need risk-bearing structures which simply the banks cannot manage. Now, in a system which is largely bank-dominated, there's no ability to offload the risks, the project risks, onto other structures which devolve directly onto households. It all flows through the banks, which creates enormous risk for the system. So financial development, by creating, say, a bond market, by creating derivative markets, which can offload some of these risks, also helps stability because it offloads the risks from the banking system directly onto households. But there's a third aspect of financial development, which I think increasingly is becoming more seen, which is the effect of financial development on enhancing financial inclusion, and through financial inclusion, creating greater political stability. Because after all, as the current debate in industrial countries go, and as the debate in developing countries has been for a long time, the more people who are left out of the formal system, the more anxiety and lack of opportunity there is there, the more political conflict eventually emerges, and that hurts growth. So if you want stable, sustainable growth, financial development contributes first by providing the possibility of growth, second by providing the possibility of financial stability, but third, through financial inclusion, which is a very important aspect increasingly of that growth. Now, the key challenges, so we all want financial development. How do we get it? The key challenges are, to my mind, twofold. Of course, there are more, but the two challenges I want to focus on today is, how do you develop financially without destabilizing the economy? And increasingly, we've recognized that there is a pace that every economy can accommodate financial development. Go much faster than that, and you create the possibility of destabilization. One example, just to set the case, is Japan in the 1980s. Overnight, created a much stronger bond market. But as it created the bond market, banks lost tremendous business. The best companies went to the bond markets to raise finance away from the banks. And so Japanese banks, left without a business, had to find new sources of entities to lend to, and we know that there was a lending boom against real estate in Japan that led eventually to the big bust, and we haven't seen the end of that bust, which started in early 1990s. Of course, there are other causes for that particular episode, but certainly the rush to lend by the Japanese banks, who had lost their business because of financial liberalization, was part of the reason. So the question is, can you do it in a way that doesn't create more financial instability? How do you do it in a measured way? And here the big arguments are, do we do it big bang? Do we do it gradually? Do we start by picking some low-hanging fruit and then move forward steadily? Or is there a time horizon within which we need to do it? Otherwise, it will be impossible. Because there's a second aspect of financial development, which is also something that is important to think about, that there are vested interests. There are interests who are against the process of financial development. In the conversations today, in the disinflationary process, for example, which is part of the process of financial development, there are people who lose out. There are people who had access to finance, typically large players, who had access to finance in the inflationary environment, and who typically enjoyed negative real interest rates. As disinflation takes place and real interest rates become positive, these are people who suddenly see the cost of finance zooming considerably. And they don't like it. For the first time in their lives, they're being forced to pay positive real interest rates. Not a happy prospect. Similarly, one of the aspects of financial development is to increase the flow of credit. To increase the flow of credit, you have to make recovery more easy. Once again, there are people who have been benefiting from access because they had access for a variety of reasons, connections, whatever, before. But now that you're increasing the strength of the bankruptcy laws, you're increasing the strength of the courts to repossess, they get hurt by the improvements in recovery processes. And they too don't like the new process because they always had access. They're not benefiting from any additional access, but now they have to pay. Well, earlier they didn't have to pay as much as now. So there are interests against financial development, and I'll talk a little bit about them. So when we talk about financial development, where do we start? And I think we start, and this is the place that you're starting at, this is the place that certainly we have focused on in India, is macro stability. Without macro stability, everything else becomes much harder. If you want to issue long-term bonds, there's no market because nobody trusts you to have control over inflation over the long term. If you want various kinds of derivatives, the risk premia that are attached to those becomes sky high. So what you need to start with is macro stability. You're on your way towards low inflation. I don't want to repeat the arguments from the panel this morning. I think they're extremely well taken on the process of disinflation. You need a moderate fiscal and current account deficit. You need moderate dependence on foreign borrowing. I think a centerpiece of all this is positive real rates. You need to generate positive real rates for savers in the economy because one of the biggest aspects of macro stability is to increase the savings rate in financial assets in the economy. Once you get that, you get a basis on which to build financial development. Without that, you're building it on quicksand, foreign borrowing, etc. So increasing financial savings in the economy is extremely important, which is why the positive real rates that we were talking about in the morning is extremely important. In addition, you need to give people a horizon over which to anticipate these things will actually stay as they are, which is why you need institutions to create credibility about policy. The kinds of institutions for inflation, we talked about inflation targeting institutions, including things like the inflation agreement with the government, the Monetary Policy Committee, but on the fiscal side, some kind of a fiscal pact, some kind of a monitoring authority for the fiscal pact. These are all important to convey to the broader public, especially the investing public, that in fact your instruments will have value going forward. I think this is much more important, these kinds of institutions are much more important today than they were 10 years ago. Why do I say that? Because 10 years ago we had a very vibrant world economy. In a very vibrant world economy, you don't have to rely on domestic demand for growth, on domestic demand for sustained development. You can rely on exporting for growth. That is the good period that Armenia was talking about, both for Argentina and for Brazil. But with the world economy looking a lot tougher now, relying on foreign demand for your growth is going to be much more difficult. You have to rely on domestic demand. And that is why we're getting domestic institutions to control macro stability is extremely important to get sustainable growth. Otherwise, we have periods of extremely strong demand, uncontrolled demand, credit booms, and followed by credit busts, all of which people in this room, including myself, are very familiar with. So, again, I want to emphasize, in this period especially with global demand weak, domestic demand is important. Creating a sustainable pace of domestic demand is extremely important, and we need institutions to govern that. Second aspect, very related to macro stability, is the stability of the banking system. And here, I think President Sturzenegger's point this morning about returns from deposits in the banking system in Argentina make it absolutely clear. Not only do you have to have positive real interest rates in the system as a whole, risk-free interest rates, but credit risk also has to be limited. Otherwise, there will be no financial savings. And therefore, to do that, you have to give people a sense that the banking system will be stable. I think the emphasis on regulation and supervision, the quality of regulation and supervision in Argentina, I think the emphasis on that is extremely important. For countries, I think luckily you're not starting with a banking sector problem. We have had banking sector difficulties in India, and there the debate was always about, do you display forbearance? Do you let the bad assets pile up and hope that someday some magic happens and they turn good? Or do you force recognition and clean up? And the supervisor, the regulator is always confronted with these choices, and I think history again and again suggests that those who rely on forbearance to bail themselves out often make a mistake. And it's better to clean up front, quickly, and do it now rather than wait for things to happen. I think in addition to that, what has become very important nowadays is macroprudential surveillance. And by this, I mean not just domestic, but also the external sector, macroprudential surveillance, how to make sure that you have a manageable pace of credit growth, manageable pace of foreign borrowing, etc. I won't go into the details. I think that's fairly obvious. The next aspect of financial development I want to talk about is new institutions. Now, for those of who have contact with the political establishment, the political establishment always wants lower rates. But how do you get lower rates? You don't just, I mean, most systems have a fair degree of competition in them, so lower rates is not through enormous amount of new competition. It's by creating institutions that can allow for easier recovery, better information, lower moral hazard, all those things that academics talk about all the time. Now, that means that in order to get good financial development, you have to create those institutions. And interestingly, this aspect, I think, of financial development doesn't arouse too much political opposition. People are happy with new institutions being created. They do worry about new institutions that create competition. And here, opening up the banking system, for example, is one source of concern to incumbent players. In India, we did this partly. We didn't have much opposition to opening up the banking system and allowing a whole new set of players, partly because the system had been closed for a long, long time. And therefore, the incumbents didn't see much of an increase in competition, perhaps until they saw how much competition was actually being allowed in. So we managed to get a lot of new competition. We allowed a variety of banks in, not just the plain old universal banks, but we created a new structure called the payment bank, which was essentially allowing mobile companies to act as banks. Now, why did we have to create a new structure here? Because we were very worried about companies having the ability to take deposits and lend. We thought that would create a problem because they might do self-lending, etc. So we created a new structure which was companies that can take deposits, but that cannot lend. So what they can really do are things like payments, transfers, remittances. They can be front agents for banks that hold the money and lend it on, but they themselves cannot lend. So this sort of narrow bank would allow actual companies that are, for example, in the mobile business, to do banking activity without taking too much risk. We also created a structure called the Small Finance Bank, which was a way for microfinance companies to migrate up into a bank-like structure where they could take deposits, but restricted them basically to lending to smaller players for the most part, so that they won't abandon their traditional business of lending. Both these have been reasonably popular in the sense of attracting a large number of applicants. We have to see how they play out. One of the biggest challenges for financial systems today is the competition coming from fintech. And of course, like everything to do with fintech, there's a lot of good that is there and there's a lot of hype that is there. And the question is to tell one from the other, right? So as a regulator, I think at this point, the only reasonable approach is a sandbox approach, which is let the experimentation start off, let some of these players into the business, just make sure that you have light regulation to make sure that the old sort of tactics of taking the money and running away don't actually work. But if you do that, then see how it plays out, and as it gets bigger, you understand some of the concerns, some of the problems, and you can decide whether, in fact, it's important to regulate. I say this because we've already seen in some of the world's jurisdictions, for example, in China, the consequences of some kinds of lending. Peer-to-peer lending, for example, we had a very, very big scandal in China recently. So there are possibilities of malfeasance in these, but I think for the most part, trusting when small and being more careful about regulation once they get bigger is probably the way to go. Now, in all this, as we are expanding competition, the key question that the regulator supervisor has to ask is how much competition is too much? How much competition is beyond what we can allow? Because at some level, rents also matter in the system. Rents are the source of equity. And if you de-equitize the system by creating a huge amount of competition, then you can also get financial instability. So the question is, how far do you go? I think at this point, certainly in India, our sense was we were very far away from the competitive frontier, and we could allow a lot more competition before we got to the point where the lack of rents destabilized the system. What is important, finally, in this process of new institutions, new entry, is to make sure there's no regulatory arbitrage, which is why it helps to have a central bank or a supervisor which supervises most of the institutions that are involved in this business, because the same kinds of regulations can be applied across the board. Now, yet another aspect of financial development, which I talked about initially, was new markets. So apart from new institutions, new markets. And here the real issue is just stepping away from blocking the door and letting a whole variety of new kinds of instruments come in. And once again, I think the operative regulation is of letting things flourish when they're small and being more interventionist once they get big enough to become potential problems. I think as macro stabilization takes place, a whole variety of new instruments start becoming important. Corporate bonds, sovereign bonds, currency, interest rate, commodity futures, derivatives, and so on. One of the problems we've had in India, which I don't know if it's an issue here, is this worry about speculation. For example, an age-old sort of part of regulation in India has been you can't issue a derivative. You can't buy a derivative unless you have an underlying to hedge. That is, nobody is allowed into the market unless they have an underlying. Now, the problem with this, of course, is who's going to take the other side? And it turns out that the only people taking the other side were banks. Again, back to the problem, all the risk on the banks. And so you have to try and convince people that speculation is not a bad thing, that speculation adds depth to the market, that allowing a lot of players in, even if they don't have an underlying, only because they hope to make some money, is not a bad thing. It's part of the market process. I don't know if you have that problem of education here, but we've had to deal with that, and we've steadily started allowing people into the markets without an underlying. That was a revolutionary move, but that allows now people to take a position which also takes some pressure off the banks to be the only ones providing the counterparty to some of these hedges. Now, two other things that I want to talk about before I turn finally to political economy. Payments. One of the most interesting parts of development today are payments. I know that you have a burgeoning, very interesting payments structure in Argentina today. Of course, technology makes a whole lot of things possible. Tomorrow you'll hear from Stefan about how in Sweden they've created this revolution where money is no longer used for the most part. Of course, that creates a problem for us central banks because our income comes from seigniorage, and the question is, what do we do to substitute? Once we go back to the bank, to the government with our begging bowl, do we become less independent at that time? But that's a problem for most of us, which is 10 years away, not tomorrow. But it is fascinating how suddenly payments have become so much more easier, especially electronic payments. Clearly, it's a big part of financial development because it brings much more into the formal financial sector, allows for better taxation, allows for more transparency. One of the important aspects that we've had to deal with in this regard in India has been to continuously keep insisting on interoperability. There's too much of an incentive for players to create their own little fiefdom, and you have to keep saying, no, I want this to be interoperable because there's a public goods aspect to that, and of course, it makes the system work much better. Most recently, what we've got is a system by which anybody with a mobile phone can make a payment from their bank account to anybody else with a mobile phone and a bank account somewhere else. And this works because it works across a common public platform and is not owned by anybody. So it can be done by anybody who has a bank account to anybody else. And I hope, based on the Swedish experience, that this actually becomes something which takes off and eliminates the use of cash. The last aspect I would talk about, actually last two aspects, financial distress. One of the most important aspects of financial development is to improve the recovery process, I said. Most countries start out the financial development process being too lax on recovery because often the financial system is driven by the large players who have access, who don't care if recovery is that good because they would get the money anyway. So often, if you want to improve access to the smaller players, you have to strengthen the recovery process. At the same time, what happens is as you strengthen the recovery process, there is a possibility that you may go too far. And we've seen this happening in India. What we've done is strengthen some laws to recover, and often it's an attempt to also recover from the big guys. But the big guys have a much stronger access to the judicial system, stronger ways of preventing recovery if they don't like it, which means the laws then become even more draconian and eventually hurt the small guy because you can always recover from the small guy. He can't hire the good lawyers to prevent recovery, but you still can't recover from the big guys. So there is an asymmetric process that takes place here, and therefore one has to be careful one doesn't become too draconian, that the institutions are fair and don't necessarily help recovery from the small guy only versus large guy. This is something that we've been trying to balance, and a new bankruptcy code should help that process. Last aspect of financial development is financial inclusion that I want to talk about. And here I think there has been a sea change in views, at least among some large players in financial inclusion. No longer are people saying that the first thing you need to do is increase credit. Because often the people getting credit don't necessarily have the best management skills for money coming in. They don't know how to manage funds. They don't know what to do with the funds. We often have this image of that cell phone lady who can go out and create a good business just getting money, but those kinds of easy businesses are few and far between. And once there's easy access to credit, those things go. So after that, the question is, are there good ways that they can can actually generate incomes, and those become harder, require a fair amount of management, require a fair amount of hand-holding. So we have gone to the view that let's start first people getting more comfortable with managing money, making payments, starting to make savings in their bank accounts. Once they know how to manage payments, once they know how to make savings, then start offering them credit, because then they'll be in a better position to manage their finances. I think that sequence is extremely important. Let me then come in the last couple of minutes to the political economy and then conclude. Clearly, there are interests who don't like this process of financial development, especially the interests who have access beforehand. There's also some opposition which comes from false notions or fear that you will have zero-sum gains. Somebody gains, it's going to be at my expense, rather than the fact that the pie as a whole grows. And so, talking from the Indian reform process, I would say there are two ways that the noise has been overcome, not the vested interest, but people who don't fully understand. And one is by experimenting a little and showing them that it doesn't matter that much, it doesn't affect them that much. And one version of this is doing it small, getting the camel's nose under the tent, showing that nothing really happens when something small happens, and then building on it. So it's again this process of gradualism, doing a little bit and then getting more over time. So for example, if it's about bank competition, let in a few banks, show that it doesn't upset the system totally, and eventually move towards a much more open system. The second has been to sneak things in, and I won't recommend this, but sometimes sneaking things in, and eventually when people wake up to the fact that it's already been snuck in, it's a little too late. That's another process. The merits of technical opacity are sometimes quite big. But this I would recommend less, but I think it sometimes also works. There's something brought in and it's too late to oppose. But I think the broader problem is not so much noise, but so much that the people, there are interests who actively oppose. And this is where I think spreading the virtues of financial development is extremely important. And this is where the central bank as preacher comes in. We have this image in Western developed democracies of the central bankers saying very little and essentially not saying very much, just doing their job and getting along. In the emerging markets, where a lot more development has to be done, I think you have to also build a case for why you're doing what you're doing and why it's important for the broader public. And that is why I think the communication as a central banker in this process of development is extremely important. It's not just about monetary policy, it's also about financial reform and why financial reform makes sense. And that's I think, an important function that you as a central banker has to play. So bottom line, great financial development is very important. Lots of interesting new avenues that are opening up nowadays. The key is that it's not a path that is absolutely without opposition. You just have to figure out how to overcome the opposition as you walk down it. Thank you.